Welcome to Inside India. I'm Sri Jegarajah. Let's get you across your headlines. Indian markets are tipped for modest gains. As New Delhi awaits advancements in trade talks with Washington, they are finding support from hopes that the Trump administration will extend a tariff pause for its top trading partners. China removes export restrictions on rare earths, minerals and magnets for the US, but their exports to Indian companies are still up in the air. A delegation of auto industry representatives is reportedly heading to China to speed up approvals. And oil prices pull back in Asian trade after a big run-up overnight after news of US personnel being moved out of the Middle East triggered worries about a supply disruption. Welcome, everybody, to this Thursday edition of Inside India. Let's take a broader look at the APAC markets, where we are seeing a fair degree of dispersion. Nikkei 225 is leading the losses, down by 0.7%. On the positive end of the ledger, the Kospi is up by 0.7, and TAIEX is down by about 1%, which is interesting because the TAIEX and the Hang Seng Index some give back there after moving into bull market territory, up 20% from the lows. So some profit taking there, perhaps, just at the margin. Shanghai Composite rounding off the story for the Greater China markets at 3,400, flat at that level. Shenzhen up by just 0.2%. Now, the Indian markets join us in about 45 minutes. Here's what GIFT Nifty futures are indicating. We are looking at more traction, actually, above this 25k level, 25,240. So that represents about 100 points to the good. Dollar-rupee exchange rate, 85.4350. Now, the US-China trade deal is still dominating market conversations. CNBC's Megan Casella has more on what we know so far about the framework deal.
After 2 marathon days of trade talks in London this week, the U.S. and China both emerged this week talking about the framework of a deal. A few details on that deal. The top line here is that China has agreed to grant U.S. companies export licenses for rare earths. But according to the Wall Street Journal, those licenses will only last for 6 months. In exchange, if China makes that move, the U.S. then will ease up on export controls on things like jet engines and student visas. In the meantime, tariff rates will remain unchanged from where they were before this week's talks. For the U.S. side, that's about 55% total tariff rates. It's a 10% baseline reciprocal tariff rate, a 20% so-called fentanyl tariff, and roughly 25% that was in place before this term. That brings us to the total 55% rate. On the Chinese side, it's about a 10% tariff that's in place on U.S. imports. Meanwhile, all of this is subject to final approval by both presidents, Donald Trump and Xi Jinping, and we'll have to see how it gets implemented from there. Here's the Commerce Secretary Howard Lutnick describing the contours of the deal earlier on Wednesday.
They are going to approve all applications for magnets from United States companies right away. Think of that language, right away. Very much like the same day, and then as they do that, we'll take off our measures, and we're in a great place with China.
I caught up with Lutnick briefly after this interview, and I asked him when we should expect to see anything in writing on this framework, and he sort of sidestepped that question. He said, remember, what we're doing in London was simply getting us back to where we were after the Geneva deal, and that's the upshot here. The two sides were not really advancing the ball all that much further forward from where we were a month ago. We're simply trying to get things back on track to see if both sides now will agree to implement this agreement, and that's what we have to wait and see, whether both presidents approve this and whether and how quickly we see it come into effect. Megan Casella, CNBC Business News, Washington.
Thank you, Megan. Let's talk more about rare earths and the global push to secure supply of these critical minerals. CNBC TV 18's Parakshit Luthra joins us now. Parakshit, thanks for joining me on the programme. So where are we in terms of the chances that China eases export restrictions for India for critical minerals?
We've not really received any positive news from China as yet. You rightly reported that there is an auto industry delegation waiting to go to Beijing for talks, and they've been wanting to go for a while. Going there is not a problem, but the reason why that trip is not materializing is because they haven't got any appointment from the Chinese Commerce Ministry or the Chinese Foreign Ministry. And in the absence of that, what is the point of the exercise of going all the way to Beijing? So that's really holding things up. On the diplomatic side, the Indian embassy in China is taking up the issue with the Chinese Commerce Ministry, asking them to show transparency in the application process, in the license approval process, and expedite licenses for Indian importers. Having said that, the impact is definitely being felt. The consensus in the auto industry is that they are fine with inventory till July, but post that, if the rare earth magnet consignments do not come in, and they haven't come in since the 4th of April, there is going to be an impact on production. Companies like TVS, Bajaj have gone on to say that their production could come to a grinding halt. And this may be true for many automakers which have a big EV portfolio. And ICE production may also have to be adjusted and prioritized because there are components which use rare earth magnets in ICE vehicles as well. Having said that, what's being done domestically? There are certain government-owned enterprises like India Rare Earth Limited, also the Gujarat Mineral Development Corporation. They have rare earth extraction capabilities. But let me tell our viewers very clearly, the Indian industry, auto industry, has never tapped these sources for their rare earth magnet supplies. We've always got them from China. So even if they were to be leveraged, it's going to be taking some time before they have capabilities to do so. What is being considered by certain automakers and has started happening is that instead of just importing rare earth magnets from China, we are starting to explore, and in some cases have already done, and that is import entire assemblies. So if you earlier got rare earth magnets from China and assembled them with the electric motor here in India, now you are getting the entire electric motor practically from China itself. What this could do is, one, increase costs, increase customs duties, and in some cases, you may have to do some retesting, revalidation, re-engineering. So all those costs for the consumers. So it's a very disruptive time for the Indian auto industry. Maruti Suzuki, though they've not said on record, we've been told by their suppliers that they've cut production targets from 26,500 between April and September to only 8,200 vehicles for this period. They hope to adjust production October onwards. And this is going to be the state with a lot of automakers, but everyone will hold their horses till July.
Great point, Parakshit. And there's a real criticality as far as rare earth mineral supply security is concerned for automotive, for defense, for clean energy industries within India. But what surprises me is I saw a figure of 7 million metric tons. This is the 5th largest rare earth elements reserves that India holds domestically. So is there an argument to be made for self-sufficiency at some point? And what is being done by policymakers to really harness, extract and process that mineral wealth domestically?
You know, ever since the start of this crisis, it is being said that China holds 90% control over rare earth processing capabilities. But these rare earth minerals, rare earth magnets are not so rare. They are found in adequate quantities in the United States and India as well. The problem is we've not really tapped into this and also developed processing capabilities, domestic manufacturing capabilities. Yes, under the Department of Atomic Energy, you have this PSU called India Rare Earths Limited. You have GMDC. Some private players are coming forward and saying they will be able to start manufacturing rare earth magnets in the next few months. But do you have magnets of the scale, the quantity the auto industry really needs? Do you have specifications, the standards that the auto industry needs? Those will be the question. And that really is the thinking within the government. In the short term, there is going to be pain over the next few months. But in the medium to long term, can we develop domestic capabilities? Can we bring in a production-linked incentive scheme? Can we give capital subsidies to domestic manufacturers of rare earth magnets? Can we give them incentives on the finished products to have local capabilities developed? All this is being done because we did not have those capabilities. We did not have a supply chain. No one sources rare earth magnets from India for the moment. And we have to consider doing that in the next few months. So this is a medium to long-term plan, but very soon we could possibly see a scheme being announced by the government to incentivize at least local assembly of rare earth magnets and possibly recycling of used rare earth magnets as well.
Great points, Parakshit. Thank you very much indeed for that. And let's continue talking about supply security of rare earth minerals and the need to develop an indigenous processing industry as well within India, and bring in Hemal Thakkar, Senior Practice Leader and Director at Crystal Intelligence. Hemal, thanks for joining us. I'm sure you heard that conversation that I had with Parakshit. And we understand that India is planning to launch incentives for recycling, which could be the answer here. 24 critical minerals, that's in the final stages of approval. To what degree is that going to help reduce import dependence that India has on China?
Okay. So, even if we start recycling, the quantum of magnets that are available at this point of time for recycling will be relatively lower. And, they may not suffice demand to a great extent. And at the same time, we do not have a recycling facility for magnets as yet in India. And that will take some time. It's a structural move. Even if it has to happen, it will take some time and it may not happen immediately.
We also touched on PLI, and Saurabh Agarwal at EY India has urged the government to introduce PLI scheme specifically for rare earth magnets and critical mineral recycling. That is crucial in the midterm towards establishing a robust supply chain. Would you agree with that? Yes. And how far and how much progress has been made on that score?
So PLI scheme is something, which will have to be first conceptualized. So generally what happens is this type of schemes give you, subsidies, tax breaks, and some financial support to boost domestic manufacturing capacity here in India. But what is important is, what is the process of, getting the PLI. So before getting into the PLI mode, the government will have to actually formulate a concept note that get a buy-in from various ministries who are involved with respect to this concept note. Then there is, a statement prepared which will lay as to who will fund this, kind of protection linked incentive scheme. And there a statement is made and then it is sent to Expenditure Finance Committee. It is called the EFC note, typically. After all these processes are done, then there is a cabinet note which gets prepared and then, it is sent to the cabinet for approval. So even if the PLI scheme has to come in formation or has to come in being, the entire process of this is not going to take less than 6 months to a year at least for the scheme to come in once the time we started.
Hemal, as Parakshit so eloquently pointed out, rare earth minerals are not that rare in India, are they? It has the third or the fifth largest reserves in the world at around 7 million metric tons. But the issue, the missing link here is production, is processing, and is refining it into these vital components.
Absolutely right. So as you rightly mentioned, we have the fifth largest reserves in the world at about 6.9 million tons as per US geological surveys, which were carried out. And if you actually see, we have not been in a position to produce this rare earth materials. As Parikshit rightly mentioned, IREL is the only company which has produced about 300 odd kgs of rare earth material last year. And the requirement that India had last year was about 590 tons from the automotive industry. So from that perspective, if you see, we are very, very minuscule. Even if we have to produce or extract rare earth elements or magnets here in India, what is going to be very, very critical is processing these, rare earth elements or magnets, wherein China has more than 90% of the capacity, and there is some capacity which is available with Malaysia and Vietnam, which is to the extent of about 7 to 9%. So apart from China, these are the only two countries at this point of time which India could have as options. But prior to that, we will have to ensure that we are able to extract this rare earth elements, which is not going to be easy, because most of the mines in India currently are at G3 and G4 level, which means, the pilot production is also not, or pilot extraction is also not started.
Interesting. So there's going to continue to be domestic supply constraints. Hemal, can you talk about the criticality? Which specific rare earth resources are most critical when you look across the spectrum for India and industries from automotive, defense, importantly, and clean energy?
Generally, there are four rare earth elements which have been spoken about, basis my discussion with a lot of people in the industry. One is dysprosium, the other is neodymium, third is praseodymium, and fourth is samarium. These are the four rare earth elements, which are generally spoken about, and they are used in varied applications, across industries. Now, when I talk about the automotive industry in specific, as Parikshit mentioned, in the electric vehicles, you may still use it, in the electric motor side, some bit in BMS by some companies, and then in charging infrastructure and applications like regenerative braking. But what is important is in the normal combustion engine passenger vehicles also, if you look at things like braking systems, power doors, power windows, wipers, all these are, assisted with motors, and all these motors will have rare earth magnets. So even in a combustion engine passenger vehicle, there are going to be a lot of rare earth magnets which are going to be there. Today, new age vehicles, all of them have audio systems. And if you look at the kind of speaker systems that you have for this audio, they also have magnets, which are
Yes.
prevalent in them for high performance. So, from that perspective, if you see, the applicability of these rare earth elements have gone up significantly in the last couple of years.
Hemal, this move at the highest levels in India to really indigenize defense manufacturing and defense equipment production, is that going to be set back? I understand that critical minerals are a very important component of these leading edge defense equipment. Is that, if there is a problem accessing secure and consistent supplies, then do those ambitions for India get set back?
Of course, in the near term, yes, there could be a challenge. The reason being, even if you look at, say, the auto industry or any other industry for that matter, the product cannot be completed till the time the rare earth magnets are integrated into the unit. So it's as good as the product being there, could be manufactured, but without rare earth, to kind of produce it, put it on road is not going to be feasible. So yes, that is going to be a challenge till the time we are able to kind of import processed magnets, which at this point of time is not locally available.
So until India and the public and the private sector really solve these challenges, do you feel that the defense industry, is there a risk the automotive industry, clean energy as well, is going to struggle to source these critical inputs, and that's going to raise cost challenges, costs go up, and ultimately it's going to mean higher prices for end users?
See, as far as what I understand is, specifically when I talk about the automotive industry, the quantum magnets or the value of magnets that are used in the automotive industry in terms of overall value per minute unit are relatively very low. Just to give you an example, if you look at the electric two-wheeler industry in India, the magnets which are there in the electric two-wheeler industry are between 150 to 200 rupees. So in terms of value, they are, kind of very, very low, somewhere in the range of about $2.50, if I have to say so, from a global perspective. But what is important is availability of them to ensure that the electric motor gets assembled and the vehicle is produced. So there is where, there is major challenge. So cost is not going to be an issue. Yes, but as Parikshit mentioned, if we are looking at alternative, kind of arrangements like sending the sub-assembled electric motors to China, getting the magnets assembled and getting them back again, or importing sub-assemblies from China to integrate here in your vehicle, then there are definitely going to be cost implications, because there will be logistics cost involved, there will be a time cost involved. All this put together will definitely lead to some kind of increase in prices.
What are the prospects for India to strike up deals with other producers who perhaps are more evolved in terms of the supply chain, into downstream, into the processing capabilities? Is that going to help resolve this issue of security of supply? I understand that India is already in talks with other producers to team together to try to resolve this issue. How much of a workaround does that provide?
So as, kind of Parikshit also alluded to this point, if you see, there are two parts to it. One is, rare earth magnets which are being produced today. And the second is, processing of these rare earth magnets and getting it here in India. When you look at the production, 70% of the production still happens in China. And then there is some bit which happens in US, Australia, and a few other countries from where we can procure rare earth magnets. But when you look at the processing capacity of these magnets, 90% of it is housed in China, and about 8 to 9% of it is housed in Malaysia and Vietnam. So even if we are able to procure these rare earth magnets, we'll have to get them processed through Malaysia or Vietnam outside China if we have to get some capacity available from them from a processing perspective. And I'm sure, in such kind of situation, the world is going to look at Malaysia and Vietnam, from a processing perspective, because everybody is struggling at this point of time as China is a large source. So I'm not too sure whether it's going to be very easy for Indian manufacturers to import processed magnets from Vietnam and Malaysia, or to, kind of procure magnets from other countries, supply it to Malaysia and Vietnam for processing and getting back to India. And all this involves a lot of rewiring of supply chain, which is not going to be very, very easy.
Understood. Hamal, in the short run, India needs to leverage all its diplomatic skills and all its diplomatic channels to engage with the Chinese government to resolve this immediate challenge around the export licenses. How successful do you think those overtures will be?
See, though the issue is more geopolitical in nature, it may be a little difficult to comment, but I'll try to give you our perspective. Now, what we feel that, we've seen that post-COVID, many countries have realigned their supply chain, or, they have diversified from single source to multiple source. And this has also led to some kind of issues for countries like China, where manufacturing has slowed down. Now, if you look at it from this perspective, India being a large consumer, of rare earth magnets, and going forward, we are expected to grow at a minimum 6.5% real GDP growth over the next 5 to 7 years. So from that perspective, if you see, manufacturing is going to be very, very strong in India, and India being a very strong consumption market, I think from an economic viability perspective, they will definitely have to look at India, and they can't kind of ignore India, as the growth on the western part of the world is actually slowing down. And India is one of the countries, which is actually driving growth globally. So that is one reason where I feel, China in a way will be compelled to, ensure that they supply, or they, kind of keep good terms with India in all regards.
Hemal, very quickly, if there continue to be these kinks in the supply chain, then could there be production stoppages in India in vital industries?
Yes, so if you ask me today from an automotive industry perspective, if you ask me, when you look at the passenger vehicles which are combustion engine, you would still say that, there is reasonable stock with dealers. And looking at the inventory that, the OEMs will have at their plants, and the current stock of rare earth magnets, I feel, by end of July, they should be good enough, and they should be in a position to manage. Maybe there could be a few models here and there which could face some issues, but largely they should be, kind of self-sufficient. But when you look at the electric vehicle industry, there is where, the challenges could be high, because stocks are relatively leaner as the demand is relatively better as compared to the combustion engine. So from that perspective, if you ask me, starting July, if we are not able to resolve these issues, then there could be a challenge, because typically most of the auto component manufacturers from where these stocks are being produced for these magnet-led, auto components, they keep a stock of anywhere in the range of 4 to 6 weeks. And, since April 4th, there has been a dry out of these shipments. So I'm very sure, these guys are going to be running out of stocks, and this is going to be very, very challenging from July onwards, especially for electric vehicles.
Very sobering perspective and context. Hemal, thank you very much indeed for joining me with your insights. Hemal Thakkar there from CRISIL Intelligence. Just ahead on the programme, JP Morgan's head of Asia Equity Strategy, Rajiv Batra, will be joining us, and we will take a sectoral deep dive into what they like for Indian equities. That's next on Inside India. Welcome back. You're watching Inside India. Some of the stories that we are keeping tabs on outside of India. The Pentagon says Marines will join National Guard units in Los Angeles to support immigration and customs enforcement agents. Troops can now temporarily detain individuals during immigration protests, a move that's fueling fresh outrage. The protests have spread to cities including New York and Atlanta, and California is suing to block the troop deployment. Court hearing is expected later today. The US is pulling personnel out of parts of the Middle East, drawing down its presence to essential personnel. President Donald Trump says the move is due to heightened security risks, adding that the region could be a dangerous place. Washington has authorized departures from embassies in Iraq, Kuwait and Bahrain, including military dependents. The Trump administration is taking a fresh look at its defence pact with Australia and the UK to build nuclear submarines. The formal review raises questions about whether the US can meet its own needs while sharing submarines with allies. We are counting down to the market open in India. This is how we are shaping up. We'll be right back in 2 minutes. Welcome back, everybody. We are about 15 minutes away from the market open for the benchmark Nifty 50 in India. This is how we are shaping up if we take a look at the futures picture. Gift Nifty futures at 25,233.50. So where we left off yesterday for the benchmark Nifty 50 was 25,141. So we are looking at about 100 points or so to the good. Dollar rupee exchange rate standing at 85.4275. Let's take a look at the broader Asia picture, since we are seeing some dispersion and there is a fair bit of let's say, choppiness associated with the narrative as it stands with the US-China trade deal. We did hear that there could be a framework, that there is a framework agreement, but markets clearly want to have more substance. Let's take a look at the broader picture, and we are seeing some winners and losers here. The TAIEX is down by 0.8%, Hang Seng Index off by about 0.5%, and this is interesting because clearly there is some profit taking going on after both of those indices entered bull market territory. And let's give you the Nikkei while we're at it. Nikkei 225 down by 0.6%. Right, let's circle back to India. I'm delighted to say Rajiv Batra is joining us now, Head of Asia Equity Strategy at JP Morgan. Rajiv, great to see you here at the SGX and welcome to Inside India. First of all, let's take it from the top down. How did last Friday's surprise 50-pointer by the RBI change the narrative for Indian equities for you?
Oh, they have delivered a bazooka for us, which people was generally looking forward for. You got during the GFC, you got that bazooka during the COVID. Now you're getting that bazooka again. So I do believe it will lead to a lot of support for Indian medium-term growth to come, not only in terms of GDP, but also in terms of earning growth too. In an environment where you are having a lower inflation, plus now liquidity will go further higher after the 100 basis point CRR cut, plus falling rate, which means it will reciprocate it into the lower auto loan rate, lower mortgage loan rate. So you are entering into a kind of a Goldilocks monetary easing kind of a scenario, which will show up in a 6-month time when you will look at earning growth and other GDP growth prints.
And there was a clear aim here by the RBI to really speed up credit and credit velocity. So are the banks a good place to be?
I'll say banks, NBFCs, consumption, auto, it will be a broad-based benefit. The reason why you have seen such a big bazooka coming out because neither borrowers were literally coming out to borrow more because the monetary transmission was not happening, nor you can say that banks were also lending. They were also parking the excess liquidity and money outside. But now with that happening and your mortgage and auto loans and other financing rate coming down over there, entire ecosystem will benefit. Banks have been the first beneficiary because people have to play through that, but NBFCs, your auto loan markets, as well your consumption, durables item, white good, anything which is linked to a leverage and stuff, secured, unsecured, will benefit on that one.
Rajiv, earlier on today on Squawk Box, Martin Sung was speaking to Sean Taylor from Matthews Asia. He's a CIO there, and he was talking about this interplay between IT services in India and the consumption story that you touched on. I just want to play you that sound from him, and then we will get your thoughts. This is Sean Taylor.
Earnings haven't been so good. I mean, the markets, we've actually been, it's been a right call. The market's underperformed that area. The whole of tech area is underperformed. It's more seen as a US play, and if the dollar's going to be weaker, then obviously it impacts earnings, and also it's a growth story. But we're very positive on banks, and we're very positive on the consumer. And one of the major catalysts recently has been rate cuts, and so we see the financials, particularly the mid-cap financials, and outside of the top couple, doing well. We like property, and we also like consumption, and you're really seeing that in the rural area picking up a bit, which is positive.
Is there a better value proposition to be had in the consumption story and the broader proxies of the global economy as opposed to IT services, which is more export focused?
Oh, definitely. And like right now, if you look at the value space in India, financials classify under that because they are trading close to 18% discount to long-term average on a price to earnings basis. And anything that can offer you a potential higher growth plus trading at a cheap valuation, it's an OSS in dessert. That's what your banks and financials are offering you. But I agree with Sean, what he's highlighting. India is moving towards more from exports to a consumption-based market, and the other way around we are seeing we are moving from urban-based consumption to rural consumption, and we do believe we are at a cusp of start of a rural recovery, and it will keep on gaining momentum.
You can't argue with the secular growth story in India and growth well in excess of 6%, but the perception amongst global investors is India is richly valued, notwithstanding last year's drawdown in the markets. Where do valuations stand?
Valuations right now in the range of around 21 to 22, and we do believe it can remain in this territory because of led by two factors. One, definitely led by the policy easing. Whenever the policy easings happen, it leads to a valuation re-rating in system, which we are already seeing. And the second factor is positioning. Remember, we are going into this year where all the three based investors like Asia, EM and Global were running a huge underweight on India. It's now they are now catching up post February and February onward, where India has started outperforming Asia, emerging market, and their other country peers also. Taking that into account, valuation can command premium and can trade at this level at longer. And on a lighter note, you can't buy gold at a price of copper. India is gold. You need to pay price for that.
And that a really interesting global perspective there, Rajiv. And so would you say that this buy India, sell China narrative is intact, or is that stretching it a bit?
It will be a stretch. We are, with the dollar going down, you are visiting a scenario where at one point of time, maybe a year or two, you will see a seller strikes in emerging market, where you don't need to choose between India or China. You will need to choose between EM and DM. And JP Morgan has upgraded emerging markets to overweight after a long time overall. So I believe growth guys may go and sit in India, and the value seekers are going to go in China. So both the countries will benefit.
There is another development within the markets, and that is the indigenization of defence manufacturing, which is quite clearly enshrined in national policy, and it really gathered more momentum, I would expect, because of these very sad and destabilising clashes recently between India and Pakistan. Again, Rajiv, I want to play you a soundbite from Lavinia Quadros, who was talking about this a few weeks ago, and then we will get your take. Here's Lavinia.
India was the largest net importer of defense equipment and it's only from 2014 that domestic manufacturing capability has really picked up, and there's been a thrust in the country for it, right? So the way I'm looking at it is, as far as certain technology goes, India is clearly out there and in a very good position to actually export that equipment. These agreements at the government to government level is very key for Indian companies to be able to export outside, because as you must be knowing as well, and investors know as well, that defense is a very controlled subject across countries. So for me, again, India is out there, and our cost of manufacturing could clearly be a good selling point.
It's interesting because defence is also goes hand in hand with the small cap narrative. But is that looking a little bit overextended from a valuation point of view, or do you like the space?
So near-term basis, yes, the sector has rallied hard. Nobody expected that. So you do anticipate there could be some amount of a consolidation. But for us, defence, power, hospitals, that is healthcare, and capital markets are a long-term structural theme. The world which we are entering, where geopolitical friction is rising, defense should be a buy and a dip kind of a strategy for you, rather than people coming and keep on selling it. We do believe there is a structural growth in play, and right now Indian stocks are not discounting a 10-year, 20-year, 15-year kind of a structural growth cycle, where India will not be just replacing their imports of defense, but India could emerge as a big exporter also in the defense market.
IT services, pharma, globally exposed, really seem to be at the sharp end of the entire tariff narrative. How selective should we be in terms of how cautiously we should approach those two sectors?
Oh, very, very selective you have to be. You have to position yourself 100% into domestic pharma names or a domestic supporting IT name with very less exposure to global markets or to the US market per se. Definitely, it is not a recession in the US, but it's not an exceptionalism also. So slowdown means you will see earnings and everything can get hit hard, which means the 24, 25p trading IT sector could be underwater, and we have downgraded IT services sector to underweight almost a couple of weeks back. And remember, there are structural concerns coming off AI. With the way which AI is getting implemented, is India fully prepared for that? Currently, we don't have an answer of that one. You are going into a phase of a disruption. And when that usually comes, valuation should be near -1 standard deviation territory, rather than even at an average also.
Trade deal, US-India, we're still waiting for some clarity on that, but there is a sense that we are moving slowly towards a conclusion in stages, maybe an interim deal in early August or late July, and maybe a conclusive deal by Diwali, mid-October, late October. Is that the way that you're seeing it, Rajiv? And how much of a driver is this going to be in terms of a positive catalyst for the market?
It's difficult to point whether it will be one full bullet kind of a deal happening or either in June or in Diwali, but yet it's fair to assume it could happen in tranches,
yes,
where it been agreed upon on certain and then moved upon to the next issue. But whenever the first tranche will arrive, market will start to pricing in that the next coming 2 or 3 tranches are also given as such. It is very important to happen before July 9th. Remember, right now we are enjoying a 20% arbitrage on tariff versus China. And this is supporting our mobile, electronics, all the market where we are exporting to the US. If the 26% reciprocal tariff arrives, it will be very disadvantageous to India, and market is not ready or pricing in that already when you are trading at 21, 22 multiple. So it is very important to sustain this valuation at this level for deal to happen before July 9th, or we don't need to see that 26% tariff arriving for us over there. But yeah, like right now, things are still fluid. We are still seeing the conversation is not just on with India, but even with Israel, Korea, Japan. So post-UK, there are too many conversations going on, and I hope something will fall soon. And that's what is our base case, that you may see it's happening in tranches.
Do you like the AI story as it applies to the market? And let me bring in commercial real estate and the property developers, because it's at a nascent stage, but there's potentially explosive growth here. We've spoken to a lot of real estate investment trusts and property developers who are looking at data center build out as the next stage. Do you like that space?
Yeah, we are overweight on real estate, not just using an angle of AI, the data center build-up, which we have seen happening in our neighborhood in ASEAN region. How the data center story played out for your construction companies, for your conglomerate property guys. A same story going to happen in India also, because they are just entering into that particular phase. So that story usually stays for at least 18 to 24 months time period. We are just entering into it, so you have a headroom. It's difficult to figure out right now that who are the key players and developers who will be operating in that space. But besides that, rate cut story, don't forget, because if your mortgage rates are heading towards the 7 handle in India,
exactly,
that will give you another boost. And remember, India's rising GDP per capita plus rising income of the middle class, especially post the tax rate cuts, will be too supportive for real estate sector.
Do you like the automotive story, especially the EV story, or are there risks and challenges there? We were speaking earlier to Crystal Intelligence. We were talking about the challenges associated with the rare earth minerals supply and the supply chain, and how that could disrupt production amongst the automotive manufacturers. Do you feel that that's the case, or is this a challenge that they can take in their stride?
No, that has emerged as a new bargain point, which we have seen between the US-China trade deal also. And it has not just impacted US automakers, it has impacted automakers globally. So for right now, 6 months, we know as a fact that the rare earth magnets and all will be exported and will be given to all nations. But yeah, that will be a concerning point if you don't have your prowess in that. That's your concern number one. Besides that, there are micro challenges also in India, where if you will start seeing post the deal with the US, if we start getting competition from EVs manufacturers from outside, so it will definitely lead to a competition. Price points will get disrupted overall. And remember, like number of cars per household have risen post-COVID over there. So taking that factors into account, we believe auto sector remains challenged. And when I said we like consumer, we like staples, we like discretionary, but ex-auto, we still remain underweight on auto sector in India.
I like a good rally just as much as the next person. We're all proud South Asians. But what could go wrong, Rajiv, with this current bullish setup that I hear? It's becoming quite consensus, isn't it? I mean, there are growth scares waiting in the wings that could spill over into India. There could be a resumption left field, India, Pakistan, a flare-up once again. There is, some might say, a household debt crisis that is brewing and building. What could derail this optimism?
Definitely all these concerns have been prevailing in India, and that's the reason why when you look at market make the previous top during September last year, Post that, India decline, growth concerns arrived, and hence you can see policymakers have started reacting toward that. If you jog your memory back to February budget, they announced the tax rate cuts, almost 1.5% of a GDP, kind of a stimulatory measure that tax cut gave. After that, it was followed up by RBI Governor Sanjay Malhotra, who gave you not just the CRR cuts, the policy rate cut, but infused a lot of liquidity into system. So all that measure shows that government and policymaker in India are proactive and sensing that external engine are slowing down, and proactively we will revive the domestic engine per se. So that will cool down a little bit, kind of an impact for you. Where the concerns rising for us or should be a worrisome factor will be the number of employments which are there in IT sector. And if you look at last 3 years net hiring trend, that number is flat, like hiring minus firing number over there. Why it is concerning? Because if too many people are employed that space and that get disrupted by AI, that leads to higher urban or a white collar unemployment per se, where your saving your loans plus personal credit card debt already is 10% of the loan growth in system, then the concern will come people who are getting fired, whether they will go for their consumption or whether they will service their debt. It's not a near-term problem per se, it's more a long-term kind of a problem if AI start disrupting. But if in India we can reskill the people towards the new job per side, the same people who are working on the software services side, they can progress towards an AI space. Hence, I will say there are concerns coming from the long-term angle side, but the near-term side, I'll say it is still very well managed, and all thanks to the policymakers on ground.
Great points, Rajiv. We'll leave it there, sir. Thank you very much indeed for joining me. Rajiv Batra there from JP Morgan. Now, those markets in Mumbai are just coming online. This is how they are shaping up. We are steady at this level of 25,155. We're back in 2 minutes. Welcome back, and we are back with a look at the auto space. General Motors up nearly 2% on Wall Street overnight after it announced plans to invest $4 billion in several US assembly plants. CNBC's Phil LeBeau has the details.
With tariffs on imported vehicles likely to stay in place for some time, General Motors is increasing its plans to produce vehicles here in the United States. The company will invest $4 billion over the next couple of years and move production of gas-powered Chevy Blazers from Mexico to a plant in Tennessee. It will also move production of the gas-powered Chevy Equinox from Mexico to a plant in Kansas. And a Michigan plant set to build EVs will instead be converted to assemble gas-powered SUVs and pickup trucks. GM has only been using about 61% of its U.S. capacity, so it has room to add production. And even though it is far more expensive to build in the U.S. than in Canada or in Mexico, GM has decided that adding U.S. production is more cost-effective, especially with a 25% tariff on any vehicle imported to the United States likely to stay in place for some time. By the way, these production changes announced by General Motors, they kick in 2027. Phil LeBeau, CNBC Business News, Chicago.
Thank you, Phil. Now, Chinese automaker Leap Motor is on the expansionary path. CNBC's Elaine Yu was at a new opening in Hong Kong. Elaine, what is Leap Motor's strategy when it comes to international growth?
So Leap Motor now has 1,500 stores around the world. And of course, it has that JV with Stellantis to take care of international sales. Now, the company said it is progressing very quickly on localizing production in Europe. It said it is now at its final stages of confirming which country to house its local production facilities. And yesterday at the store opening, executives did talk about the impact of EU tariffs or the plans to set minimum prices on Chinese EVs. So let's take a look at what Senior Vice President Cao Li said about tariffs yesterday.
With a minimum selling price, small cars will have no competitive advantage because their price would certainly fall below the discussed price range, right? Therefore, I believe that in the future, to meet the needs for small cars, including essential models, we will need to make proper plans. This includes controlling costs effectively. Moreover, only through localization can we truly adapt to the needs of local users.
So it does sound like localization will be important, especially for Europe's small car market. And of course, it benefits from that partnership with Stellantis, so it can tap into its network of dealerships and also, crucially, after-sales service in Europe. So if you have to fix a car part, you can get that done more quickly onshore in Europe. But at the same time, analysts have told us that, on the point about localization, if EV makers have to, they're forced to build capacity in Europe, that doesn't really help with the overcapacity question in China. Because the whole point of exporting cars is to take that pressure off overcapacity. So there are tough calculations to make there as well. Sri.
Interesting, Elaine, and the CEO putting a brave face on that intense yet brutal price competition in the Chinese domestic market. Thank you very much indeed for that. Now, Indian markets have been trading for just a few minutes. Let's give you the Nifty 50, which is steady at this level of 25,160. Dollar-rupee exchange rate also steady at 85.46. Let's bring you up to speed with some corporate stories that we're watching in India. Billionaire Gautam Adani's Adani Enterprises is reportedly aiming to list its Adani Airports unit in 2 years. Adani Airport operates 8 airports across the country. The move is reportedly part of a growth plan that also includes investing $100 billion across businesses in the next 5 to 6 years. Shares of parent Adani Enterprises are looking like this, steady at 2,584 rupees. And Geo BlackRock Investment Advisors has received the green light to operate as an investment advisor, according to its parent company, Geo Financial Services. This is a joint venture between Reliance Industries and BlackRock, which was BlackRock's way of re-entering the Indian market after exiting a local JV back in 2018. It's one way of capitalizing on a rapidly growing market. Consultancy firm Knight Frank projecting the number of ultra-high net worth individuals are growing faster in India than in any other geography. Right, I'm afraid that's all the time that we have on this Thursday edition of Inside India. Do keep watching CNBC. Dan Murphy is coming up next with Access Middle East.